with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, May 15th, 2026. Got to do some shout outs here, some big shout outs to Richard, Ron, Ben. Got to give a shout out to Leah, my mom. We had Mother's Day last Sunday, so big shout out to all you moms out there, including mine, who tunes in week in and week out. And a super big shout out to Kevin out there in Arkansas, holding down the fort at the world's largest retailer. Kevin shoots me an email, says, David, it's going on 20 years. I love the last week's podcast. Thanks for being disciplined and not chasing every dollar. Well, thank you, Kevin. Thank you for being with us for so long, and thank you for tuning in. And you know what they say, and I've said it on here before, bulls make money, bears make money, but hogs get slaughtered. And look, I love bacon. I love slow smoked ribs with a dry rub, preferably Bad Byron's butt rub. Very, very good. I even do a ham where I inject it with maple syrup. I smoke it in a roasting pan with apple cider. Turns out wonderfully. I love pork tenderloin. I love scrapple. I like it all. But let me tell you, your portfolio would not taste very good as pork. I'm just saying. So we don't want to get slaughtered. And that's why we do what we do, Kevin. Thank you for recognizing, my friend. So what's going on with the markets this week? Well, not so hot. Dow Jones down 1% on the week. S&P 500 flat on the week. NASDAQ flat on the week. The Russell 2000 Small Cap Index, which is the hottest index of the year, folks, is up 15.8%. 15.8, but it was down 2.4%, 2.37 this week. There's a reason for it. We'll get to it in a moment. Taking a look at some other things. Volatility index, it bounced higher this week, finished at 18.4. Here's a doozy. Long-term bonds as measured by the TLT down 2.8% on the week, negative 2.8%. And again, that's tied hand in hand with what happened to small caps this week. Same with the next one, gold and silver. Gold down 3.8%, silver down 5.4%, all for the same reasons. We'll talk about them in a moment. And then when we take a look at the sectors, the only thing that was really, really shine this week was energy. And a lot of that is just because, look, this war in Iran is not settled, right? I saw headlines today, Sledgehammer Part 2, right? So we're going to talk about coming back at them hard and strong again. And look, even if we didn't, I think I mentioned a few weeks ago, Paul Sankey, maybe the top oil guy analyst in the world, super sharp guy. He has identified the fact that there are some structural problems with the oil market at the moment. So even if things were to resolve with Iran, it does not mean oil prices come crashing back down to earth again. And I'll tell you, look, we always saw a glimpse of that a couple weeks ago when the ceasefire was announced and it looked like a deal was on the table with Iran. Oil dropped, but it only dropped about 7%. It's really kind of hung in there. Now it's on its way back up again. My point being, it didn't come all the way back down to 60. Okay. And I think that even if things resolve themselves with Iran, there's going to be some longer term issues here in the energy markets, could keep oil prices elevated. And we're heading into the summer driving season, et cetera, et cetera. What about the rest of the sectors? Staples, which are defensive, up 0.5% this week. Healthcare, also defensive, up 1.1% this week. Other sectors were down, and they were down quite a bit. Materials down 2.5%, industrials down 1%, consumer discretionary down 3%, real estate down 2.5%, semiconductors, which have been leading the way, down 1.8%. So what's driving the markets this week? Well, there's a few things going on. Of course, we've had earnings. They continue to come out, and the earnings picture has been good, and reactions to earnings are good. We've got Cisco in our moderate risk models for income. We got a lot of you folks out there are retired. You're taking that check every month, and we need to put money in technology, but most tech stocks don't pay dividends. So years ago, we added Cisco back in the way down there in the 30s, paying a 5-6% dividend at the time. Now it's at $118. Had a monster quarter this week, up 22.4% on the week. So nice return there. We're seeing a lot of these tech stocks just continue to do very, very well as they report earnings and stocks get pushed higher. But the rest of the market not doing so hot. So earnings have been pretty good. We've got some economic data that's been mixed but concerning. So, for example, the manufacturing data was really good. PMIs were pretty good. Those numbers have been in the doghouse for years, so we're seeing some positive action there. But inflation numbers this week, absolutely horrific. We had horrific inflation. Now, I expected it to be bad. Expected it to be bad because of the oil prices going up. But listen, the headline, Consumer Price Index, CPI, the headline number was 3.8%. The Fed's target is 2%. We were 3.8%. So, well, David, war in Iran, oil's higher, so of course, the number's going to be up a little bit. Yeah, I understand. I'm with you on that. So let's take food and energy out of it. 2.8%, still much hotter than where the Fed wants us to be. And then PPI, Producer Price Index, this is on the wholesale level, came in at 6% on the headlines, the highest numbers we've seen, folks, since 2022. If you think back to 2022, that was a really nasty, ugly year. We had horrific inflation. Stocks and bonds did poorly. We've got some defense built in for such a thing this time around. Nonetheless, these numbers not looking so good, up 6%. And take out food and energy, take them out, positive 4.4%. So we're just seeing sky high inflation right now. And is it temporary just because of oil? Or is it going to stick around longer? Is it going to be more sticky? No one knows for sure. I will tell you this. I mentioned in our 2026 outlook that one of the things that this market was not prepared for in any way, shape, or form was a resurgence in inflation. Okay, prices going higher. And with that, this is what's driven the action this week, folks. Remember I told you all the things that happened this week that looked really wacky, right? Small caps down 2.4%, bonds down 2.8%, gold down 3.8%. Why did all this happen? Because these inflation numbers are nasty. And the market has said, hey, forget it. There will be no rate cuts. And now the market's starting to look at and entertain potential rate hikes down the road. So you put all that together, you start raising interest rates, small caps aren't going to perform well. Long-term bonds are not going to perform well. And gold probably won't perform well because you say, well, David, if inflation's there, why isn't gold performing well? Because when you raise rates, you are strengthening the dollar. And when the dollar goes up, gold a lot of times goes down. So we're seeing all this reaction to the inflation print this week, which may be short-lived. It might be short-lived because of oil prices. But when you strip oil and energy out of it, it was still hot. Okay, it was still hot. Another thing that I've seen, saw a story this week, under the surface, kind of anecdotal, but talking about consumer credit. We're seeing the largest expansion in consumer credit in years, like 10 years. We've also seen the biggest increase in credit card defaults in like 9 years. We're starting to see cracks on the finances of the consumer, and that's also a bit concerning. A little anecdotal right now, but concerning. Now, let's shift away from some of this fundamental stuff and talk a little bit about technicals, because we had a couple of things happen this week that are concerning on that front. If you recall, a few weeks ago when the market was down in the gutter, back there in March, we started coming back up again. And so once we crossed a certain level, and I don't remember what the level was at this point, it was like around 7,000, 69 something, whatever it was. So we get over that and we hold it. We're probably going higher, probably towards 7,500. That's kind of was the target that we were watching here as far as what they call a measured move. When the market breaks out, you get a measured move in that direction. That measured move was 7,500 on the S&P. We hit that yesterday. But then today, it lost almost 100 points and finished at 7,400. Okay, 7,400. So we were up nicely to that level, and now it's rolled over. But here's what's concerning. We got hit this week with something called the Hindenburg omen. Okay, yeah, right. It sounds really spooky, right? The Hindenburg omen, because when you think about that, you think Hindenburg blew up and was a bowl of flames and ended very, very badly. I think the term is a bit hyperbolic. Okay, it's a bit hyperbolic. But here's the thing. When it hits on one index or another, it kind of spells some trouble. And what this is, let me explain to you what the Hindenburg omen is. It is a measurement of the 52-week highs and the 52-week lows, okay? And what happens is when you have both 52-week highs and 52-week lows hitting extreme levels at the same time, that is a market that is way out of whack, way out of whack. If you remember last week, I told you I'm very concerned about this market because it is literally being driven by a very small handful of stocks, okay? The broad market is not participating the same way that the AI trade has been participating. Well, when the Hindenburg omen hits one index or the other, it's a coin toss. Doesn't really mean anything. But look, this week it fired on two indexes. The NYSE and the NASDAQ hit on two of them. And when you go back and you do the numbers, you run the numbers, you look at how many times this has happened in history, which isn't many times, and then you look at the market returns after it happens, just let me tell you this, it's not good, okay? Not good. Normally a pretty rough ride for a while. And we had that happen this week. We've got terrible breadth in the market, not a lot of leadership. We've got some sell signals being flashed on the DeMark charts. I think I mentioned that last week. We've hit that measured move to 7,500. We just put all this together, and I just think that the downside risk is a little greater right now moving forward here in the coming weeks or months. So what does all this mean for you? Well, it doesn't mean anything for you because you're in good shape, all right? We've already put you in good shape. We've been trimming, right, along the way. We've been trimming some of these big gains, tucking some of that profit off to the side. So we're in a really nice position at the moment. If the market wants to act up, that's okay. If stocks and bonds both want to act up and misbehave, that is quite all right because we have that nice position and nice exposure to manage futures and commodities, which they had a very nice week this week, being up 4% or whatever for the week. So my point here being, we're in good shape. I don't trust the market. I haven't trusted it for a while. It's been a nice run, but it's also been very thin as far as the push higher here. And I think that could spell a little bit of trouble for us. So, and not only that, you still have some macro headlines that could knock things around like the war in Iran, et cetera. So listen, for all of you folks that have added money, we're just sitting on it. I've not put it right to work for you as the market's been hitting all-time highs. I've been sitting on it. For all of you new clients, we haven't worked your money into the models yet. So folks have been coming over just the last couple, 3 weeks. Money has come in the last 2 or 3 weeks. We're just kind of sitting on it at the moment. But we will be looking to get more constructive on the market. Should it pull back here? And if not the market as a whole, there's areas, right? There's pockets that may drop. And as that happens, we'll look to go ahead and step in and fill those areas in the portfolios. But for everybody else, it's the status quo right now. Just going to hold tight, keep things positioned as they are, wait for better opportunities. I think we're positioned very nicely. Touch on the defensive side. Nothing wrong with that. Let this market go ahead and do what it wants to do. Look, it could take off again. Don't get me wrong. I've got no crystal ball, folks. I don't want to try to act like I do. But it's the weight of the evidence approach, right? You look at all of the tea leaves and you try to make sense out of it. And again, the bottom line is the risk reward doesn't look so hot right now. So we stay a bit on the defensive side. So I'm going to wrap up. Between now and next meeting, you're thinking about your future, long-term goals, all the things you want to do with you and your money. Retire a little early. Take that big trip. Pay for that college education. Hey, you know what your goals are. Don't just think about it. Think big. Think B-I-G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.